Everyone in Canadian personal finance is talking about XEQT, VEQT, VFV, the S&P 500, the TSX, the same ETFs. Every video. There are 3 Vanguard ETFs that almost nobody is covering, that have genuinely interesting characteristics, real track records, and specific roles a Canadian portfolio might benefit from. One of them is quietly beating the S&P 500 in 2026, while nobody watches. One is the cheapest and most diversified way to own all of Canada. And almost everyone picks the more expensive, less diversified alternative instead. And one pays monthly income from Canadian real estate, without you being a landlord, at a cost most people have never heard of. 3 ETFs, all Vanguard, all overlooked, all worth knowing about. ETF 1. VYMI. The International Dividend ETF, outperforming the S&P 500 in 2026. VYMI is the Vanguard International High Dividend Yield ETF. It launched on February 25, 2016. It turned 10 this year. It tracks the FTSE All-World ex-US High Dividend Yield Index, which is exactly what it sounds like. A basket of high dividend-paying companies from developed and emerging markets around the world, with one deliberate exclusion: no U.S. companies. The fund holds approximately 1,100 companies across Europe, Asia, Canada, Australia, and emerging markets. The top 10 holdings represent only 13.4% of the fund, making it one of the most genuinely diversified international ETFs available. No single company can move the needle on its own. The expense ratio, 0.07%. That is $7 per year on every $10,000 invested. For a fund holding over 1,000 companies across dozens of countries, it is an extraordinary value. The 2026 story. Here is why VYMI belongs in this conversation right now. The S&P 500 is up approximately 13% year-to-date in 2026. VYMI is up approximately 19.3% year-to-date, while paying a 4.78% dividend yield on top of that price return. Total return, including dividends over the past year, approximately 29.5% to 31%. The context: 2026 has been the year international equities have finally asserted themselves against the decade-long dominance of U.S. technology stocks. The S&P 500's concentration in 9 AI-related companies has made it vulnerable to sentiment shifts in a single theme. International markets, less concentrated in AI, more concentrated in financials, energy, and industrials, have benefited from exactly the environment 2026 has provided: elevated energy prices, strong financial sector performance globally, and investors seeking diversification away from stretched U.S. valuations. VYMI captures all of that at a cost of 0.07%. The performance track record: 2025 full year, plus 38.02% 3-year annualized, plus 24.5% 5-year annualized, plus 14.2%. Since inception, 2016, plus 10.6% annually. Why most Canadian investors have never heard of it? 2 reasons. First, it is U.S. listed, not Canadian listed. You access it through a brokerage that allows U.S. stock trading. Questrade, Wealth Simple Trade, with U.S. trading enabled, or any bank discount brokerage. You need to buy it in U.S. dollars or use Norbert's Gambit to convert currency efficiently. That extra step keeps most retail investors in the more accessible Canadian-listed alternatives. Second, Canadian personal finance content is dominated by the XEQT and VEQT conversation. Both of those all-in-one ETFs include international exposure. Approximately 22% to 25% of their holdings are in international developed and emerging markets. But that international sleeve is market cap weighted, which means it is proportional to global market sizes. VYMI is yield weighted. It specifically overweights the high dividend-paying international companies. What it is not. VYMI is not a replacement for XEQT or VEQT. It is a complement, specifically for investors who want to tilt their international exposure toward income-generating companies rather than market cap weighting. It is also not a low-risk fund. International equities carry currency risk, geopolitical risk, and the specific risks of each country's regulatory and economic environment. The tax note for Canadians: VYMI is U.S. listed. The RRSP treaty exemption applies to the portion of dividends sourced from U.S. companies. But VYMI holds no U.S. companies by design. Its dividends come from European, Asian, Australian, and emerging market companies, all of which have their own withholding tax rates at source. The treaty does not cover these. Some will be reduced via bilateral tax treaties between Canada and those countries. Others will not. For most Canadian investors, RRSP is still the best home for VYMI because it provides some treaty protection on whatever U.S. proximate income flows through, but do not expect zero withholding on international dividends. The honest assessment: VYMI is worth knowing about. In 2026 specifically, when international has beaten the U.S. and income investors are looking for yield without full U.S. concentration risk, it is one of the most interesting ETFs available. For a Canadian investor building a dividend portfolio with global diversification, it fills a gap that XDIV and VDY, both entirely Canadian, leave wide open. ETF2, VCN, the cheapest way to own all of Canada, that nobody picks. The problem with XIU: if you ask most Canadians which ETF to use for Canadian equity exposure, many will say XIU, the iShares S&P/TSX 60 ETF. It has been around since 1999. It is the oldest ETF in Canada. It has enormous brand recognition and enormous trading volume. It also charges 0.18% per year, and it holds exactly 60 stocks. VCN charges 0.06% per year, and it holds approximately 190 to 207 stocks, including large, mid, and small-cap Canadian companies. That is 3 times cheaper and 3 times more diversified. The fee difference, 0.12% per year, sounds trivial. On $100,000 invested over 20 years at a 7% gross return, VCN produces $382,652. XEU produces $374,155. The fee gap, $8,497. From one decision made once, from choosing the cheaper, more diversified option over the more famous one. What VCN actually holds. VCN tracks the FTSE Canada All-Cap Domestic Index, which includes not just the largest 60 or even 240 Canadian companies, but the entire investable Canadian market across large, mid, and small capitalization. The top holdings are familiar: Royal Bank, TD Bank, Shopify, Brookfield Asset Management, Enbridge, Canadian National Railway. But below those household names, VCN holds the mid- and small-cap Canadian companies that XIU ignores entirely. The sector breakdown is similar to any broad Canadian index: approximately 30% financials, 17% energy, 12% industrials, 12% materials, 10% technology, with the remainder in consumer staples, telecom, utilities, and healthcare. Distributions are quarterly and paid as eligible dividends, making VCN tax-efficient in a non-registered account thanks to the dividend tax credit. VCN versus XIC. The honest comparison. There is another strong competitor in this space, XIC, the iShares Core S&P/TS, X-Capped Composite ETF. XIC charges 0.06%, the same as VCN. XIC holds approximately 240 Canadian stocks versus VCN's 190. Both are excellent. The difference is essentially the index they track. XIC follows the S&P/TS X-Capped Composite. VCN follows the FTSE Canada All-Cap Domestic Index. Both are legitimate choices, and the performance difference between them over the long term is minimal. The key point is not VCN versus XIC. The key point is VCN or XIC versus XIU. Either of the cheaper, more diversified options is meaningfully better than paying 0.18% for 60 stocks. Why nobody talks about VCN? It is not exciting. There is nothing interesting to say about it in a 5-second hook. It is cheap, diversified, and it quietly works. Vanguard Canada does not market aggressively. XIU has the brand. XIC has the iShares marketing. VCN has the best fee and quietly sits in the background being excellent. Morningstar rates it. Broad exposure to the Canadian stock market at a low price. A simple formula that few of its peers have been able to beat in the long run. Published April 27, 2026. If you are adding Canadian equity exposure to a portfolio, VCN belongs in the conversation. It simply never gets invited. ETF3, VRE. Monthly real estate income without being a landlord. VRE is the Vanguard FTSE Canadian Capped REIT Index ETF. It has been around since November 2012. Over 13 years. It has $282 million in assets under management. For context, XEQT has over $14 billion. VRE has $282 million. It is genuinely obscure. It holds 19 Canadian REITs, every major one, capped so that no single REIT can represent more than 25% of the fund. The holdings include Granite REIT, Dream Industrial, Canadian Apartment Properties, RioCan, Allied Properties, CT REIT, Crombie, Smart Centres, and First Capital. It pays monthly distributions, not quarterly, monthly. 7 cents per unit every month, which at the current price represents a yield of approximately 2.94%. The MER is 0.39%, higher than VCN or VYMI. That is the price of specialization in a relatively small ETF. The honest performance context. Before getting into why VRE is interesting, the honest performance picture. The one-year total return is 1.49%, including dividends. That is weak, not catastrophically weak. REITs as an asset class have been under pressure globally since 2022 as interest rates rose sharply. REITs borrow heavily to buy and develop real estate. When borrowing costs double, REIT values fall. That is what happened from 2022 through 2024. The average annual return since VRE's inception in 2012, 5.73%. Not spectacular. Not bad. Consistent with a relatively low volatility income-focused asset class. Why it is interesting right now, the Bank of Canada has cut rates from 5% in 2023 to 2.25% today. That rate decline is the single most important variable for Canadian REIT performance. Lower borrowing costs directly improve REIT cash flows and valuations. The full effect of 2.75 percentage points of cuts has not yet been felt in REIT prices because the cuts are still relatively recent, and the market is still uncertain about whether cuts continue. If the BOC holds at 2.25% and eventually continues cutting, the historically reliable relationship between lower rates and recovering REIT values applies. VRE at $282 million in AUM is a very small fund. Rate cuts will not make headlines about VRE, but investors who owned VRE when rates were falling in previous cycles, 2008 to 2015, 2019 to 2022, saw significant total returns. What VRE does that individual REIT picks do not. Owning 19 REITs automatically. No research required on individual REIT payout ratios, balance sheets, or tenant risk. No concentration in one sector of real estate. The 25% cap prevents any single REIT from dominating. So a Granite REIT outperforming or a RioCan struggling does not define the portfolio outcome. Monthly distributions arriving automatically, which, combined with DRIP, creates genuine compounding of real estate income without any active management. The honest risk, VRE, is not for an investor who needs strong total returns in the short term. It is a rate-sensitive, sector-concentrated ETF with a 1.49% one-year return. If rates stay elevated or rise, VRE underperforms. It has done so in the 2022 to 2024 period. The thesis for owning it rests on the BOC rate cycle eventually continuing lower, which benefits real estate valuations. For an investor who wants monthly income from Canadian real estate, does not want to be a landlord, and believes rates have peaked, VRE is the most direct expression of that thesis available in Canada, at 0.39% per year. 3 Vanguard ETFs, all overlooked, all worth understanding. VYMI, the International High Dividend ETF that is outperforming the S&P 500 in 2026, while yielding 4.78% at 0.07% in fees. For investors who want international income diversification away from U.S. concentration, there is almost nothing better available. Accessible in an RRSP through any brokerage that trades U.S. securities. VCN, the cheapest and most diversified way to own all of Canada. 3 times cheaper than XIU. 3 times more holdings. $8,497 more on $100,000 over 20 years. It is boring. It works. Morningstar rates it one of the best in its category. Nobody talks about it. VRE, monthly Canadian real estate income at 0.39%. Weak recent performance because rates were high, which is the same reason the thesis for owning it now is more interesting than it was in 2023. 19 REITs, 25% cap per holding. Monthly distributions, $282 million in AUM, genuinely under the radar. None of these replace XEQT or VEQT for a core portfolio. All of them fill specific roles that the most discussed ETFs do not. The best investments are often the ones nobody is talking about. These 3 qualify.